take us away.
Hang on, wait.
It's definitely going in the intro.
Why don't you just consume the mint like a normal person?
Swallow it whole.
Steve, too close to the mic again. Back that thing off.
It's going to be like it's going to be like a scene out of The Office, right? Or out of like The Big Short. It's like ordinarily I would never do that, right?
All right, get on with it.
Welcome everybody to our latest episode of Bugle Notes, where we sound off on the topics that we feel like are relevant to our clients and to others in our industry. And so I'm Stephen Weitzel, joined by my partners Joe Perdue and Michael Bennicelli. And today we're going to be talking about behavioral finance and biases and
Maybe a little bit of forecasting. Consensus.
Ways people make mistakes in thinking about their money, the emotions that dominate our decisions. So let's kick it off.
Yeah. I mean, probably the best thing to do first is just give everybody an idea of what we mean when we say behavioral finance. So, I don't know, Joe, you're going to be our resident expert. How would you define it?
Behavioral economics is the melding of economics and psychology. And the best way to have some understanding of where that comes from is a little history. In the 50s, 60s, post-World War II economic boom we saw in the United States, there was no such thing as behavioral economics. There was no thinking about biases or psychology in general. That was a very unrelated topic, an unrelated world from the business world. But what was happening at that time was a couple of independent schools of work in psychology, one being Drs. Myers and Briggs, starting in the 50s, or doing their work on a framework and a language for understanding behavior. Personality tests, right. And separately, over a few decades during that period, you also had the meeting of a couple of smart fellows, Daniel Kahneman, whom we lost. R.I.P. We lost last week, a couple weeks ago, and Amos Tversky. And these two fellows, I think they met maybe in the late 60s, did most of their work in the 70s, and ultimately their work in behavioral economics earned them a Nobel Prize in economics, even though they're
not economists.
Right, so that was a first. But just speaks to the groundbreaking nature of bringing an understanding of behavior into business. And as it applies very directly to what we do, it's a departure from the mainstream financial theory that investors are rational actors.
Which we know they're not, right?
I think we addressed that pretty well on the last podcast. I think that was the beginning of it, you yelling about, people not being rational.
I did not yell. I'm guessing the academics have never met investors, right? Because investors are not rational people. I did not yell.
Was he just close to the mic?
It's very close to the mic. We're working on that.
So, I mean, the idea that we as human beings make decisions in our best interest at all times is a flawed underlying assumption to that way of thinking. And so this bringing psychology, understanding that emotion so often outweighs reason, it's important in life, but particularly important in our world of investing and making the decisions that are in our best interest.
Can I insert this? So the idea to that end of why would people play the lottery, right? So we know rationally the likelihood that you're going to win the lottery is infinitesimally small,
right?
And I don't know how it's been equated. That you've got a a better chance of being struck by lightning like 3 times than winning the lottery or whatever it is. But I remember studying economics in college, and there's actually a division of economics or studying economics of this idea of preference for lotteries is the way it's academically described. That even though you can tell people we're going to do a lottery, and it doesn't have to be like the big lottery where you're going to win potentially hundreds of millions of dollars, even billions of dollars, but that it could be a raffle of some kind, and you tell people what their odds of winning are, and they can be incredibly low to where they rationally would not choose to participate. But invariably, most of them are going to, because of, in their mind, maybe they ascribe some sense that they have a better chance to win than rationally what the numbers would bear out.
Sure, and I'm sure they also, you think, very low, very easy entry into this.
Yeah, low commitment.
Chance, low commitment, and the emotion attached to this visualization I can create of what life would be like with, $100 million in my back pocket, outweighs the logic and reason of that decision.
That's right. If I can part with $2 and potentially get back $100 million,
yeah, how do you not do that?
that's a good return.
No doubt.
That is solid. That is Hall of Fame type return on investment.
Really changes the financial plan. So
Yes.
we'd have to adjust that scenario. But look, let me get back to. I want to get us into the topic that Michael mostly wants to discuss here. As these social scientists are doing work over the decades leading up to where we are now with what is a very common way of thinking about business and human behavior in a social world, the idea was that Doctors Tversky and Kahneman developed a framework for thinking about how we think, how our brain has evolved to make decisions, and to make the dozens and hundreds of decisions we'll make each day. We need a way to do that very intuitively, very quickly, and that is what they called a system 1, and there's also a system 2. A system 1 being very easy, very active, very intuitive, and we use it quickly and often. A system 2 in our brains that's much more deliberative, more time consuming, more resource intensive for our brains, and we'll use that sometimes. And that part of our brain, that part of behavior, is less prone to biases, but system 1 is the one that's in there doing the work. It's the one that really wants to be active.
Mm-hmm.
And
It's primitive, right?
it's more primitive, certainly, and therefore more prone to the multitude of biases that allow us to make decisions not in our best interest.
Yeah.
And that will tie into some of the topics I think we'll discuss today. There are many in the financial world that we see, and they have very little, if any, link to intelligence. Mm-hmm. We have clients who are very intelligent. You might suggest that we have some level of intelligence ourselves. We're all prone.
Some more than others.
We're
Not pointing any fingers.
We're all prone to these mistakes, though, and it's because it involves emotion, and emotion's going to often override logic and reason.
I know this is a topic that we're definitely going to cover many times throughout whatever the life of this podcast ends up being, just because it's an enormous topic, right? There's so many different ways you can talk about it, but maybe just to drive the point home, can we give an example or two of something that you would define as a behavioral bias?
Yeah, sure.
Something that would...
Yeah, there are plenty to choose from.
Anchoring bias.
Arguably, I'd say the most common one we hear about or discuss with clients is loss aversion bias. The simple, easily understood concept that gaining $1 versus losing $1, we have twice the emotional reaction to losing a dollar as we do to gaining a dollar, the joy that comes with gaining a dollar. So there's a mismatch there. We're much more sensitive. We feel twice the pain when we lose a dollar versus the joy we feel of gaining a dollar. Mm-hmm. So that's loss aversion bias. Stephen mentioned anchoring, another quite common, where our brains latch on to a piece of information and therefore disregard other equally pertinent pieces of information.
Yeah.
Ties in often to availability bias. If the information is readily available, I'm going to pay more attention to that and make poor decisions because I'm dismissing other information equally or more important because it's more difficult to get to.
I mean, an example of anchoring would be, could have sold my house for X last year and now it's, X minus whatever.
So now I refuse to sell it unless I can get
I've lost money because I could have sold it for that.
Exactly.
Correct.
Right?
Or, most commonly, I bought a stock at $100 a share,
Right.
and even though you may be able to see news that suggests that the outlook for said stock is souring, and it's currently at $90 a share, trending lower, that person is unlikely to be able to part with that stock because in their mind, even though on paper they're already down $10 a share, that, and our industry promotes this too. They say, well, if you don't sell it, then it's not real, that it's just on paper, which, I don't know, is like some sort of sleight of hand, but most people will not actually take action and extricate themselves from that position until they get back to 100, so they don't have to feel any pain associated with that.
So are you getting a phone call or are you doing real-time research over there?
Well, one of the things that I was going to share here as it relates to the losses and the pain of losses versus the joy that one feels from winning is something that I'm going to borrow from our friends at the other RWM out there, Ritholtz Wealth Management, where in one of their recent podcasts they were discussing the Andre Agassi autobiography that came out. And since Joe's here and a tennis player, I feel like this is appropriate for him. But he talks about, Agassi does, that in his career, that the first time that he won a Grand Slam, that he won a major tournament, that he had been defeated a number of times in that finals match and was just devastated to not walk away victorious. But when he finally won, he says that, I'm in this privileged club that very few people are ever going to be able to enter into and know what it feels like to win this trophy, to carry this mantle. And of course, he's riding high for that short period of time, but within a certain distance of time gets away from him actually winning, and he recognizes that the joy that he's carrying from actually winning pales in comparison from the pain and consternation he still feels of losing those previous ones.
Yeah.
And so I think it's true of so many different areas within our life, not just investing, that you remember the games that you lost. You remember the things that you either did wrong that prevented you from achieving your goal, and those are the things that stick with you, and are really in your crawl, right? Versus if you actually accomplish what you're trying to, it's like, hey, that's great, but I don't remember the wins.
Yeah, no,
I remember the losses.
I think that's true of every competitive player that I know. We all dislike a loss more than we like a win. And if I could tie that into what we'll discuss as it relates to finance and investing, all we can do is be aware. All we can do is try to keep in mind that we have these inherent biases. There's not much we can do about them, but be aware and try to have a plan to deal with it. When I'm playing tennis and I'm close to winning, I know that I'm going to get conservative near the end. I'm going to worry that, all right, I'm playing not to lose now. It's similar to loss aversion bias. If you start playing not to lose because you really don't want to lose, you end up losing. You have to be aware of it and try to force yourself out of that.
Prevent defense, right? You go into the prevent
Go
defense.
into the nickel.
Oh, good Lord.
And how many stories we could share about that? But it is interesting in sports. Think about it in football, that there are times where you get up big in a game, and the coach decides that the things that we've been doing successfully in this game to get us to the point where we have this big lead, we're going to go away from those. And because at that point, they just want the clock to be their friend. And, how would you say that we do that in the investing world? I mean, you go away from the things that you've been doing well to, so, I mean, how does that translate?
I think it mostly translates in that nothing arguably is more important than removing emotion from the decision-making process.
Okay.
Because when you're in the prevent defense, not only, maybe the book says, I go into this defense because I don't want to let the receiver get behind me and score a touchdown to catch up with the score, but emotionally, I'm also in prevent defense. I'm no longer aggressive. I'm no longer doing the things that made me successful.
This is going to hurt some people being, Atlanta Falcons fans listening to this.
Hard, I know.
28 to 3.
That is probably
Was that in the back of your mind when you?
No, what was actually in the back of my mind was the 2013 Georgia Tech game, where we were up 20-0, and that game was played at Bobby Dodd, and we were rocking. And Georgia.
First of all, Bobby Dodd.
Bobby Dodd is
never rocking.
Listen,
it's never rocked.
It rocks often, right? But we're up 20-0. Todd Gurley. I'm trying to remember who their quarterback was. Murray. Maybe
Really don't
Aaron
care.
Murray.
Honestly.
But anyway, but it was going to be a massive upset, and they obviously show up expecting us to run the ball. Paul Johnson running the option. We come out throwing, get up big, and then we don't throw for the rest of the game and end up losing in double overtime. That's what talking about the loss is sticking with you.
We're going to move on from that because you're making nightmares.
I'll tell you, I want to move us on by this. I don't know where I read this. Maybe one of you guys may have actually sent it. I can't remember. But while we're still on sports, a study or a paper written by a somewhat famous psychologist almost 50 years ago was called Basking in Reflected Glory. And it was, did you send me this? I don't know where I read it. But the idea was a survey of sports fans.
Okay.
Right. And so how consistently they all not only verbalized this, but felt that if their team won, we won. Their team lost, they lost. So that, I thought, tied in nicely. That idea of human nature, human behavior, ties into some of what we're talking about today regarding analysts.
I would say that is a passive fan right there. That is a passive fan.
Fair enough.
That is not a Philadelphia sports fan, I'll tell you that.
Nope. We win, we lose. Win more than lose recently, but hey, draft was last night, so
It was. Let's not spend too much time on the Michael Penix Jr.
Right.
more Falcons fan nightmares.
That's right.
So one topic I want to make sure we do discuss, and it ties into this behavioral finance topic, which is the idea of consensus in the financial industry, and really the group think that kind of causes it. So, I mean, how would you define just consensus as a whole, right? It's related to forecasting. It's kind of what everybody thinks collectively.
Sure. So again, most of our industry, they're looking at things through more of a fundamental lens, and they're trying to gauge what they think might be coming down the pipe, and how are we going to position ourselves for that. And whether that's you're investing or you're running a business or whatever it is, you're trying to have some gauge about where we feel like things are headed in the future. And so the industry will have a number of different ways that they model out how they think the future could look, whether it's, because of interest rates or earnings or, a sundry list of factors that because of X, Y, Z, we think that we're going to experience X, Y, Z. Maybe here's kind of our base case, here's our bull case, here's our bear case, which is kind of funny in that they would say, it's almost like saying, ask me what I think's going to happen, and I'm going to tell you, but if I'm wrong, it's either going to be this or this. And so I'm going to give you a wide cone, and then maybe I'll be able to say, well, it fell within the range that I expected. So I will say every time I hear groupthink, I hear Doug Cass saying group stink, because the one thing about our industry, and whether you're turning on Bloomberg or CNBC or Fox Business or whomever it is, and you have these analysts that are coming out and they're making either recommendations or giving their forecast about where they see things going, that there's zero or little accountability that these people are held to. And there's this concept that if an analyst is wrong, if you ask me where I think the S&P 500 is going, and I tell you I think it's going higher and it goes lower, that an analyst can revise their forecast.
Sure.
And
the government does it too, right?
Well, and you see that very often here. And here's the interesting thing, that you'll have, and I know that's probably where we're going with this whole consensus thing, that you'll have loads of analysts working for all sorts of different firms across the street that are trying to give what they believe is the appropriate value for ABC company. Right. And they may say that, the stock's at 100, and they say, well, we think it's worth 120. Well, they're going to report earnings, and they report after the market closes on one day, and maybe they miss earnings. And the stock after hours, it's tanking. It's going to open the next morning at 90, okay? And
in other words, they lost.
They lost. Well, who really lost, okay? Before the market opens the next morning, you'll turn on the TV and you'll see there are analyst downgrades. And now their forecast for the stock, it isn't 120 anymore. Now it's 85 or 90. Well, and so if an analyst is wrong, they have a revised forecast. If an investor is wrong, they are subject to a capital loss. So they're the ones actually taking the capital risk, where the only thing that an analyst could potentially have is some sort of quote unquote career risk if they start to step outside the bounds of what everybody else is saying.
But if I can speak in defense of analyst accountability.
You think you're
Well, when I started my aspiring investing career, 1991, buying the 20th Century Aggressive Growth Fund, young second lieutenant in the Army.
Mm-hmm.
Really got it rolling with that. Went in big.
Yes.
And making $1,500 a month. So
nice.
going in strong.
Nice.
How's it gone since then?
Contributions are up.
So back then, this was pre-internet, right? I didn't, it's tough to find information.
Sure.
Tough to get information. There was no CNBC on the TV. Oh, I guess there was a CNBC maybe at that time, but not in my world. And when you're getting snail mail analyst reports, proxy statements, things like that, there's no ready access. There's no real-time access to information and change like there is now. So if you're an analyst now, one thing that is different, and it is true, is you're getting bombed on social media if you, and it's immediate. So,
Maybe.
So you have to hedge with some of the things you're mentioning, because there's not accountability in the sense there is investor accountability with a mistake, but it's not like it goes unnoticed in most cases. In our world.
Not that it goes unnoticed or that people are aware of it. There's no accountability. And if there are probably umpteen different examples that are out there where the forecast that analysts have for a stock or a sector that they're covering, that their price targets, all it does is follow what the actual price of it is. So I'll give you a good example here.
Got a good one for you too.
So if we can, I'll find the chart so we can include it here. But it came from our friends at All Star Charts, that if you looked at the historical composition of the energy sector within the S&P 500, that it peaked out in more recent history at around 16%. Joe has it. Look at that.
Prepared.
It's called prep.
Prep. See, you just got to be ready to sit down and go where the conversation takes you. But so it peaked out in before the financial crisis around 16%, and everybody wanted to own energy there, and nobody saw downside for oil. Crude went to 150. All everybody wanted to talk about at that point was the analysts almost wanted to outbid each other, raising their forecast for how high crude could go. And so if you looked at how many buy recommendations were on ExxonMobil, Chevron, Halliburton, Baker Hughes, whatever it is, that there were buys across the board and the price targets were just up and up. Fast forward to 2020, when we passed the 4-year anniversary of the May 2020 crude oil contract turning negative, settled at negative $38. I remember that at home, since we couldn't go into the office. Like in all the textbooks, right? They all tell you that when it gets to zero, you can't lose any more money than that. The fact that you had a commodities contract go to negative $38, kind of breaks the math. But at that point in time, which you look back now with some perspective here, would have been a really good time to be a buyer of the energy sector. How many buys were on the energy sector at that time? Almost none. Everybody was telling you to sell, and there was no hope that the energy sector was ever going to rebound or recover. So they told you that you needed to be buying it, was their recommendation at the peak. They were telling you to get rid of it at the bottom. And so they just seem to be following the price trends of that particular sector.
So this goes into why I decided I was going to write a white paper, and it'll come out soon. I mean, do I smile and look at the camera? And the paper is really about the idea of consensus, the idea of groupthink, and analyzing what the consequences are for an analyst, whether they're right or they're wrong, in consensus, out of consensus. And so, if you think about it from that lens, right, there's really only four places an analyst making a call about a stock or a forecast for the S&P or whatever it might be. There's only four places they can end up, right? They're either in consensus, out of consensus, right or wrong, right? So, and the consequences for that are very different, right? So if you make the correct call and you're in consensus, good for you, right? Everybody else made the correct call. Everybody did it together. Excellent. That's where you're supposed to be. If you make the incorrect call, but you're in consensus, you're doing what everybody else is doing, you get a free pass, right? Nobody else got it right. You didn't get it right either. Really no consequence for you being wrong because you did what everybody else did. If you make an out of consensus call and you get it right, you get an offer to be a hedge fund
promotion,
manager, right?
You get a movie made about you, right? The Big Short.
Yeah. So, that's somebody who's willing to step out and they manage to get it right. People recognize that, they reward it. Great, right? It may be, that they may have been lucky. The reasons are unimportant, right? It's just the fact that they were, against the grain and they made the right call. But if you are out of consensus, you're not doing what everybody else does, and you make the incorrect call, that's how people get fired, right? You're essentially saying, I'm smarter than everybody else. I'm going to make this out of consensus call, right? But you get it wrong, and the question you get is, well, everybody else got it right. How could you possibly get it wrong? So because of the imbalance of the consequences, right, people are always going to be biased towards doing what everybody else does. And so part of this white paper is we conducted an experiment. Really simplistic. We were sponsoring a golf tournament and had a good population that we could test this on. And the experiment that we ran was, again, very simplistic. So we had a jar. It was full of Starburst. And we asked people as they came by to guess how many Starbursts were in this jar, right? And we divided these folks up into three groups. So some of the folks that came by, we told them no information. We said, just guess, right? There was no prize for winning. There was no penalty for losing. We just told them, we're doing an experiment. Do you want to participate? Take a guess, right?
That's a number.
For a third of the group, we gave them the average up until that point, but we made up the number. We basically gave them an artificially low number. So I think the total number that was in there was 294, and we told them it was 188, right? For the other third of the group, we gave them an artificially high number. We told them it was 387 instead of the actual 294. And so, the results basically proved out the idea that people are influenced by what others do, even in the lowest of possible stakes. So, we'll put the graphic up there and we'll show everybody. And of course you can read the report, but it was incredible to me that you're talking about something that's literally got no consequences.
Means nothing.
The stakes couldn't possibly be any lower, and people were still influenced by what everybody else did. So if that isn't if you think about it in those terms, right? In this case where there are no consequences, right? And then you frame that in the idea that you've got analysts whose jobs might be on the line if they do the wrong thing. All of a sudden this, simple concept becomes a really, really powerful force, right?
Just as and I think this dovetails so well within this behavioral finance discussion, but just talking about the book in the movie, The Big Short, okay, that there are a couple of times in that movie where, so first of all, if you've seen the movie, read the book, you know that it's about the guys who saw the crisis coming in the housing market and made bets against it, which was incredibly out of consensus at the time. They turned out to be right. They made massive returns. That's where they made their name. So if you're, to your point, if you're out of consensus and you're right, you get fame and fortune and glory. Okay. But there were times, even within the movie, where even though they ended up being right, that the trades were going against them. And, there's a scene in the movie where Christian Bale, who's playing Dr. Michael Burry, where his fund is down like 20% for the year. And this was, I think, in 2006. And the market was up. The S&P 500 was up that year. And his clients were suing him. They thought that he had breached his duty to them. There's a scene where he's laying on the floor in his office in the fetal position, right? And so where we know how it turned out for him because he maintained his conviction and the timing worked out for him that he made these massive returns. But there are plenty of investors that when they get to the fetal position, right, which is where he was, that there were people that were trying to bail on his fund at that time because they couldn't take it, right? They were in pain. They wanted out. And so if you're out of consensus and you end up right, they'll write a book about you. How many of them, what if Michael Burry or some of these other guys, what if they would have capitulated when their client said, I can't take it anymore, and they closed their trades out, and they ended up with losses? There'd certainly be no book, no movie, right? But so I feel like there's a lot of lessons in there.
There are a lot of podcast topics in there. Even future podcast topic, luck and chance. Ooh. And I don't want to speak. You mentioned Michael Burry in The Big Short, and I don't want to speak disparagingly about anyone by name, but there are some smart people who've made the right call once, made the wrong call many times.
Mm-hmm. Oh yeah.
There are people I would suggest as smart or smarter than Michael Burry, who's a really smart guy, who analyzed all the data at the time, 2006, 2007, came to a different conclusion. They were wrong. Mm-hmm. How do we look, how we perceive that in a world that is far from black and white?
Yeah.
It's virtually never black and white, and we're virtually always dealing with probabilities.
Right.
And we're dealing with many things out of our control. And again, here I am defending analysts again. Tough gig.
It is a tough gig. So let me, I want to throw out some examples of just how bad forecasting generally goes. And then I think we'll probably try to wrap it up. But so I pulled out a couple of examples just because I think this will probably illustrate the point pretty well. So 2022, not a great year for the S&P, for the bond market, whatever. It was not a good year for most things.
Anything, yeah.
And I'm looking at S&P targets. So at the beginning of the year, I guess the end of the previous year, whatever, everybody puts out their target for what the S&P is going to be at the end of the year. Why? I have no idea. It's nonsense, right?
They do it every year. It's a pastime.
Every year, right? So Morgan Stanley, 4,400. Wells Fargo, 5,300. Goldman Sachs, 5,100. RBC, 5,050. You go down the list. Credit Suisse, 5,200. Right? You remember where the S&P ended 2022?
I'm going to say 4,000.
No. 38, 39, 50.
So I was close. I was within a tolerance. Yeah.
Close enough.
Yeah.
I mean, certainly closer than the forecast, but that's one example, right? Everyone at the beginning of the year thought 2022 was going to be a great year. It wasn't a great year. So there was an article, I believe it was in the Times. Actually, I got to go back and look now. Excuse me. Maybe it was Wall Street Journal. Anyway, written by a guy named Jeff Sommer back in 2020. And it was basically about, this topic of how poor forecasts had been for the S&P. the S&P is an easy one to pick on because everybody's got a forecast and, they all stink. But he looked at the forecast from the year 2000 to the year 2020. The average return that was forecasted for the S&P was 9.5%. The average return for the S&P was about 6, right? So that in itself is not great, right? You're off 3.5%. But what's even more ridiculous is when you break down the numbers and see that every forecast from 2020 or 2000 to 2020 called for the S&P to go up.
Yep.
You know how many down years there were?
4.
6.
6.
There were 6 down years in 20 years, which is roughly, about average, right? You look back into history, that's pretty normal. But there wasn't a single year where the consensus forecast was for the S&P to be down.
Well, and they always have to have a carrot, right? Because when they do this exercise, and forecast season is always late fourth quarter, looking into the next year, and they've got to have they have to have a carrot for investors man, I've probably put up with a lot of market volatility and whatever this year, and why am I going to stay in, right? And so it's interesting if the average gain that they would forecast is about 9.5%, because I think that's roughly equal to the S&P's historical annualized average. Which is ironic. I mean, you could dive into this more, that the S&P rarely has an average year. That you're some standard deviation above and below that, but I don't know exactly how far you're going to extrapolate this out. But if rationally, if people in the investment community know that maybe the market's down 1 out of every 4 years, something like that, if that's kind of a historical cadence, that you get 3 years up and 1 year down, that how ridiculous is it that your S&P target at the beginning of every year is higher? You're never forecasting a down year. I don't think the first down year that they forecast was until 2023, right? Where the consensus was that the market was actually going to drop. 22 was so bad, and they were caught so off guard, and all of the reasons why the market had pulled down in 22 didn't seem to be abating for 23. And some of them actually came to fruition in 23, of things worsening as far as interest rates rising and that type of thing. But 23 was the first year where they were actually forecasting as a group that the market could decline, and it went up.
Yeah. I mean, I don't know how you put any credence into any of it, and I don't know. I think I ignore them, honestly. I think it's great. It's fun marketing to see who's picked what and what they think, and there's so much work that goes into it, and hundreds of people working on this, and it's just nonsense.
Fairly meaningless in the end.
But they stand by this stuff so hard. I mean, they'll come on the TV, and
even further to that, they're judged against it, right? I mean, I was looking back at this list from 22, right? These banks where everybody was off by a massive amount. I don't think anybody lost their job at the end of 22 because they made a bad forecast, did they?
No, and so
because they all made the same.
They all made the same mistake, right? And so but they always, you'll have whatever of the investment strategists from the large firms, the one that was kind of the closest kind of gets put up in lights. He or she gets a lot of airtime the next year. It's good marketing, but I can think of 2 examples historically of when you've had a CIO inside of these big firms where they have been more conservative, out of consensus, and wrong, in that the market went away from them. One of them is David Rosenberg. who was the CIO at Merrill Lynch back in the early to mid 2000s, that he was very cautious and probably for some of the housing related reasons, but he was not bullish, and the market continued to run away from him, and it makes it very hard for these large firms to go out and tell their clients, you need to be invested, and your CIO is saying, hey, don't really like this market. And so he ended up moving on. And then the other one more recently is Mike Wilson at Morgan Stanley. Very thoughtful guy. He was the one who was probably closest to a forecast for 2022, even though he was still a little bit too bullish maybe for where it ended out in 22. But he was very bearish. He was the most bearish for 23, got a lot of airtime, and ended up being the most wrong relative to where the market finished. And the news came out, maybe 2-3 months ago, that he's going to be exiting that position.
Focused on institutional clients, but not necessarily on the wealth side.
Yeah. So to that end, you have, and he had conviction in what he was doing and the way that he was modeling and viewing the world. Was very defensive. It didn't work in his favor because the market ended up doing well where he anticipated it doing poorly, and it ultimately cost him his job. Yeah.
But to speak more to the uselessness of the whole thing, he was very well reasoned.
No, absolutely was.
Nothing he said sounded crazy at the time. Things didn't play out that way, and it cost him. So there was, I guess you could say there's occasional accountability.
Maybe the lesson is just to not try to predict the future.
Yes. I believe a famous philosopher once said that making predictions is hard, especially about the future.
It's a good place to end it, I think. What do you think?
All right. Let's end it there for now. So, hopefully this discussion's been insightful for our folks tuning in, and really more of an opening foray to the behavioral finance discussion to recognize the fact that we're emotional creatures as human beings, that we don't always make rational investment decisions, and we need to be aware of the biases that we have and how they can have negative implications for our investing, and how we stay in line with our financial plan. So anyhow, with that, thanks everybody for tuning in. So for Michael Bennicelli and Joe Perdue, I'm Stephen Weitzel, and we will see you next time.
I'm so ready for this to start.
I'm so ready for it to be over.